the long-term interest rate of the U.S. Treasury long-term rates, 10-year rates, 20-year rates, 30-year rates, have hit a very low level. And I'm not talking about the lowest level since this century or this decade. Basically, we are in an epic event in that the interest rate for the U.S. Treasury is the lowest since the organization and commencement of the U.S. bond market, which is 1790. Since the commencement of the United States, which had debt outstanding day one, the interest rate this past year, in fact, up till about a week ago, have hit the all-time lows. So this is an epic event. So what is happening? Now, realize that a Treasury bond is a fixed rate instrument, meaning it is issued, the bond is basically a contract that is issued, and it has a fixed stated maturity, at which time the owner is paid the principal. But in the meantime, they are paid a fixed dollar interest payment. It is called the fixed rate market, meaning that the interest rate is not created by the issuance of the instrument, but in the secondary market every day, that bond trades, and the higher the market will pay, the more the demand, and the higher that the market will pay for that bond, the issuer still receives the same contractual interest payment. So basically, the coupon becomes a smaller percentage of the price being paid in the secondary market when the prices are high. So basically, low interest rates correspond to extreme demand for the bonds. Investors are willing to buy and accept a low yield. In fact, it's called the yield to the buyer until maturity. So the question is, what in the world is happening in the market that's causing such great demand for the Treasury and the willingness to pay such high prices that the yield is the lowest in the history of the U.S. Long-term debt market? Well, there has to be a lot of demand coming from somewhere. The usual explanation is for private investors being willing and interested to buy U.S. Treasuries. The peak of that interest usually comes when we're in a recession, deep recession, or even worse, in a depression, when there's a shifting of investment allocations out of equities, which take the full brunt of a recession or depression, and an attempt to shift that capital to the long-term bond market. Being the U.S. bond market, it also corresponds to the lowest risk, as the investors see it, the lowest chance of a default. So what encourages private demand for the Treasuries is a depressionary circumstance. What also happens during a depressionary circumstance, there's less demand. In fact, if demand really plummets relative to supply, prices fall, and we have an actual deflation, which actually becomes more beneficial to own a fixed rate instrument in a deflationary environment. And as long as it's paid, the contractual income has a greater command over goods and services in a deflationary environment. So the ultimate private environment to be buying treasuries at yet higher prices and lower yields was in the Great Depression of the 1930s. In that environment of depressionary deflation, the ultimate private demand sunk to a 3% yield for the long-term treasury. We were there not too long ago. Now in September 2019, we're well below that rate. And the 10-year has actually, in the past year, fallen in half. The yield has fallen in half. This is the yield of the 10-year Treasury at 3% a year ago, and now this week it fell down to 1.5% for the 10-year. These are epic low rates. So who are the buyers pushing the price up in the Treasury market? Well, we pretty much ruled out the private investors who would respond to a deflationary depression to be motivated to buying treasuries and be happy to receive a 2% nominal yield and a higher real yield as prices fall. But basically, we're not in that environment. The economy is still moving forward, so we must rule those out. Then the next explanation typically is the central bank. It has been at least 50 years that we've been educated. In fact, I've been part of the education process since the Keynesian revolution, pointing to the central bank altering the interest rate to accommodate aggregate demand. But basically, have they done that? Well, they did that during the QE days, but the QE days have been over for a few years, and the Fed spent a few years lightening their portfolio, being a net seller than a buyer. So where in the world is the demand coming from? Well, it turns out if we rule out the U.S. investors and we rule out the U.S. central bank, then the fingers point very clearly to investors from abroad. And that is, the motivation is clear. In Japan, their central bank jacked up bond prices with a massive buying program, pushed the price up not only to lower the yields in the market to a low positive number, then to zero, and then to a negative rate, which is almost inconceivable. But basically, that has occurred and been maintained in Japan for a number of years. In the last few years, the quest for a central bank to try to jack up bond prices to the point of lowering the cost of money first to zero and then to negative has switched to euro. Last fall and last winter, the ECB, in response to a softening European economy, went back to negative interest rates, and they started to run the printing press to give them the ability to buy fixed-rate sovereign bonds from the EU. They didn't buy U.S. treasuries. They only purchased treasury, the sovereigns within the European community. So then the question is, where is the buying coming from? It's not from the European Central Bank directly, but it is, in a sense, indirectly, in that all the private investors of the institutional private investors in Europe are looking at receiving yields not just low, not just zero, but negative. Now, if you're an investment manager for example, a pension fund, and you're purchasing, and you're forced to purchase, actually, you're pretty much mandated to buy sovereigns in that country, and you're mandated to buy sovereigns with negative yields, well, the pension fund will not earn the proceeds sufficient to make good on the pension benefits. For example, in the United States, CalPERS is a pension fund for the California Public Pension Fund. Of all the California pension funds been consolidated under CalPERS, and the CalPERS fund has to earn a 7% yield on average every year to make good on their future pension obligations. Well, negative rates are well below 7%. So having been stuck in that corner of the market where they would not be non-performing pension funds, and it's also insurance companies would become non-performing, and endowment funds supporting universities and other endowment supported charities, etc. They're not earning the proceeds to maintain the spending on their obligations. So it appears that this year that the private pension managers, and this is not public policy, so it doesn't get printed in the paper, but it appears that the pension managers have abandoned their internal controls, which dictate them to only buy European bonds. And the reason is that as a pension manager, if you sell euro-denominated bonds and buy US dollar-denominated bonds, you're now taking exchange rate risk. So that was pretty much ruled out, but apparently they went past that and bought dollar-denominated treasuries earning perhaps 3% as compared to a minus 0.5% of a European bond. They could also buy some exchange rate insurance so that when the day comes that the bond reaches maturity and the proceeds go back to the owner, they could insure in the financial markets that pay out in euros as opposed to dollars. And that insurance is about 1% a year. So it appears that they have now abandoned in Europe, the private managers have abandoned the constraint of maintaining themselves in the euro-denominated investments. Now that has all kinds of implications for the U.S. financial markets, which I will go through in the succeeding video.